Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we'd come to you today with a little bit of an update on the market, kind of let you know what's going on out there. It's a little bit of a down morning. We are at about 45.25 on the S&P 500, which is still well above that kind of 4,400 range that we had traded in for most of July. And I really think the key headline that we're going to take away from today's market update is that after a series of up days, many days in a row of being up, I think the market was looking for any type of excuse to maybe consolidate a little bit. And so there is a headline out there around Fitch downgrading U.S. Treasuries, which we will address. But I think that really the overarching headline for today is we have been up many days in a row, and it was time for the market. The market was kind of looking for an excuse to consolidate around a little bit lower level. That's actually healthy from a trading perspective. Moving on to Fitch. Most of you probably woke up this morning to see a headline that says that they have downgraded the credit rating of the United States from AAA down to AA+, which is, in response to an expanding level of federal debt, but also in response to growing sort of political uncertainty or governance concerns, which is just a generally veiled threat to say, hey, we don't really love it when you guys run up against the debt ceiling as a political negotiation tactic. I'll just throw out there that the reaction of the administration, Janet Yellen called the decision completely arbitrary. And Larry Summers, who's a former Treasury Secretary, went even further and called it, quote, bizarre and inept, which is interesting. The timing of this is very interesting. There are three credit rating agencies that are out there, S&P, Moody's, and Fitch. S&P and Moody's are by far more widely recognized than Fitch is. However, there are three that are out there. S&P downgraded the U.S. government back in 2011 from AAA to AA+, and that was a big to-do within the marketplace, which has subsequently obviously been rolled over. That was over a decade ago, just so we're clear. Moody's has kept its credit rating at AAA, and Fitch decided to downgrade now, which is a little bizarre. It's not bizarre in the context of how rating agencies work, but I think that everybody needs to understand that credit rating agencies move very slowly and tend to be pretty reactionary in their ratings adjustments. So it's not really a reaction to anything that's happening today or even this week or even last month or the month before. It tends to be more a cumulative effect over time, and honestly, a little bit late to the party. In this case, I probably agree with both Larry Summers and Janet Yellen that, hey, the problems that you're pointing to are interesting and they're out there and we've acknowledged them. However, if you look at overall economic conditions, the U.S. economy continues to grow and is actually in a much better place than we were, call it 6 months ago, 3 months ago. So the timing of the downgrade seems a little off. And indeed, the market reaction to it is rather muted. I think 10-year treasuries traded up approximately 5 basis points on the news, which is less than 0.1%, in terms of yield. So a little bit of a negative reaction, but not really any discernible movement. And then equities are off maybe 1-ish% today. But then again, if you look at where we are over the course of the past 4 or 5 weeks, equities have certainly rallied. And I think after the strength of the rally, equity markets were looking for a little bit of a reason to consolidate. In terms of what's been driving the rally, I would remind everybody that we are in the middle of corporate earnings season, and those corporate earnings numbers continue to come in pretty much ahead of disappointing consensus. So, the total number of companies that have reported so far is right around 270, and on a net income basis, we are up about 3% year over year, and on a revenue basis, we're up about 2% year over year. Neither one of those things is something where you would be like, oh my gracious, earnings are up 3%. That's amazing. However, when you put it in the context of what analysts were expecting, which was an earnings decline of 12% coming into the quarter, saying that we're actually up is quite meaningful. And so it's nice to see you've seen a little bit of a market. I don't know if you'd call it a relief rally. You've seen a little bit of a, hey, numbers are way less worse than feared or at least talked about by analysts in the marketplace, which has really caused that move up from the 4,400 range into that 4,500 range that we talked about before. Meanwhile, the other bit of news this week has been jobs. On the jobs front, we got a JOLTS job openings report yesterday that showed that we had not only 9.6 million job openings in the United States. And there were some pundits out there that were saying this is the lowest level since April of 21. And it indicates that the labor market is cooling. And those indications, that's correct directionally. But I would just remind everybody that for all of 2018 and 2019, which were sort of banner years for the U.S. economy in terms of economic growth, or at least good years for the U.S. economy in terms of economic growth, we had job openings that were between 6 to 8 million. So it's nice to say that, hey, the job market looks like it might be cooling down a little bit. But I just remind everybody that, our unemployment rate is still in the mid threes. That is very, very low. And if anything, we might be moving closer to normal, but still hot relative to, where we were throughout much of the last decade in terms of actual job market dynamics. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.